Planning to own a senior home care agency? You might want to think twice. Not because you shouldn't do it, it's because there's a real gap between what this looks like from the outside and what it actually costs. And that gap is exactly what this video is for. The pitch is genuinely compelling: purpose driven work, recurring monthly billing, low overhead, and a customer base that isn't going anywhere. More than 8,000 Americans turn 65 every single day. One quick clarification before anything else. This is about non-medical home care. Help with bathing, meals, companionship, daily tasks. No medical license required. That's a different, simpler business than a licensed home health agency doing skilled nursing, which is a longer, more expensive path entirely. The U.S. home care industry is worth $173.6 billion in 2026, and the workforce behind it is in the middle of a real crisis. The industry needs roughly 7.8 million more caregivers by this year alone, a 76% jump from 2014. So what happens to a recurring revenue business built entirely on a workforce nobody can find enough of? That's what we're figuring out today. One quick note before the numbers start. Every figure in this video is real, sourced, and independently checked, but costs and regulations shift by state, city, and sometimes zip code. Treat these as your benchmark, not a quote for your specific address. A second note, specific to this episode. This video describes non-medical home care specifically, not medical home health or hospice, which involve different licensing entirely. It's not legal, tax, or business advice. Licensing rules for this industry vary significantly by state, so verify your state's specific requirements before acting on anything here. The first cost, the one that splits cleanly into two very different price tags, building your own agency from scratch costs less than most people assume. Buying into a name costs a lot more. A non-medical home care agency, built independently, typically costs $40,000 to $80,000 to get licensed, insured, and staffed enough to take on real clients. That covers business formation, your state license application, bonding and liability insurance, initial caregiver recruitment, and basic scheduling software. Buying a franchise changes that math significantly. One well-known brand's franchise fee alone runs $55,000, with another $94,000 to $146,000 in additional startup costs. All in, that's roughly $149,000 to $201,000 before you've served a single client. The trade-off is speed. An independent agency typically takes 6 to 12 months to launch, once you account for licensing, hiring, and building referral relationships from zero. A franchise can often open in 2 to 4 months, because the systems and training are already built. Licensing itself hides a few costs first-time owners don't budget for. An incomplete or deficient application often needs resubmission, which means additional fees and months of delay. If your state's inspection finds deficiencies, you may need consultants or facility changes before you're cleared to reopen the file. Most non-medical agencies reach break-even in 6 to 12 months. That's a real, survivable timeline. It's also not the part of this business that actually determines whether you're still standing in year 3. The hidden trap, the one built into the workforce itself, not the paperwork, every single caregiver who quits costs you more than the wage you thought you were saving. Home care runs on an hourly workforce, and that workforce is genuinely hard to keep. When a single caregiver quits, the real cost, counting disrupted schedules, missed shifts, new recruiting, and the client relationships damaged along the way, runs over $14,000 per departure. That number isn't rare. It's the industry's central operating reality. The market for caregivers has been described, accurately, as pulled tight as a drum, and only about 35% of agencies even offer health benefits, one of the more direct levers available for keeping someone. Wages vary enormously by state, which makes this worse in some places than others. A caregiver in Louisiana earns around $11 an hour. A caregiver doing the exact same work in Hawaii earns around 18. Several states have pushed caregiver wage floors toward $20 an hour in just the past year, specifically to fight this exact turnover problem. An owner who treats caregiver pay as the line item to minimize is optimizing the wrong number. Every dollar saved on wages that shows up as higher turnover gets erased, and then some, by that $14,000 replacement cost, repeated across however many caregivers walk out that year. The real engine, the one sitting in the gap between two numbers most owners never write down side by side, what you bill and what you pay, were never supposed to be the same thing. The spread is the business. So where does a well-run agency actually make its money? The spread. The national median rate families pay for non-medical home care is $34 to $35 an hour. Caregiver wages, depending on the state, run roughly $11 to $20 an hour. That gap looks like pure margin from a distance. It isn't. Payroll taxes, workers' compensation insurance, general liability coverage, scheduling software, and office overhead all come out of that spread before a dollar reaches the owner. What's left after all of that is real, but it's thinner than the headline hourly numbers suggest, which is exactly why the turnover math from a moment ago matters so much. A spread that was already carrying taxes, insurance, and overhead has very little room left to also absorb a $14,000 replacement cost every time a caregiver leaves. The agencies that protect that spread aren't the ones chasing the cheapest caregiver they can find. They're the ones who pay competitively enough and build enough consistency into scheduling that the $14,000 number rarely gets triggered in the first place. Retention isn't a nice-to-have here. It's the actual mechanism protecting the only margin the business has. The real money in home care. The hourly rate was never the business. The gap between that rate and what it actually costs to keep a reliable caregiver on the schedule is the business. And owners who try to win it by underpaying almost always end up paying it twice. Once in turnover, and once in the client relationships that turnover damages. Industry benchmarking data on private duty agencies puts real numbers behind how this plays out at different stages of ownership. A typical, successful independent agency, 3 to 5 years old, generates just over $2 million in annual revenue and around $270,000 in owner compensation. A comparable franchise agency, 2 to 4 years old, generates $1.1 million in revenue and around $182,000 in owner compensation. Run the percentages, and the comparison gets more interesting than it first looks. The franchise's owner compensation works out to roughly 16.5% of revenue. The independent's works out to about 13.5%. The franchise system runs slightly tighter as a percentage, likely a real benefit of the training and operational systems you're paying that franchise fee for. The independent owner still takes home almost $90,000 more in absolute terms because they've built roughly double the revenue base by that same point. A live, currently listed agency makes the ceiling on this business concrete. One agency on the market right now reports $6.3 million in 2025 revenue and $1.57 million in cash flow, having grown more than 30% over the prior 2 years. Same industry, same basic hourly math, an enormous range of outcomes. The variable connecting all three is how deliberately each one managed the spread between billing rate and caregiver retention, not how big the territory was on day one. So let's run the two real outcomes. The optimistic case. You pay competitively for your market from day one, invest early in scheduling consistency, and build direct referral relationships with a handful of local physicians, senior centers, and discharge planners instead of relying on paid ads alone. Turnover stays well below the industry norm. By year 3 to 5, you're tracking toward that benchmark $2 million in revenue, with owner compensation in the low to mid six figures, consistent with what well-run independent agencies report. The realistic case. You launch lean, keep caregiver pay at the local minimum to protect your margin on paper, and treat recruiting as something you handle only when a shift is already uncovered. Turnover runs high. Each departure quietly costs you that $14,000 in disruption and rehiring, client consistency suffers, and referral sources that were sending you new clients start sending them elsewhere instead. Revenue growth stalls well below the successful benchmark, not because demand was ever the problem, but because the workforce underneath the business never stabilized. Same license, same hourly rates available in your market. The entire gap between those two outcomes comes down to whether caregiver retention was treated as the actual product being sold or an afterthought to filling shifts. So is it worth it? If you're picturing steady recurring revenue with minimal day-to-day involvement, that version exists only after the workforce problem is genuinely solved, not before. What's true is that this remains one of the more durable, demand-secure businesses on this channel, backed by a demographic trend that isn't slowing down, for owners willing to treat their caregivers as the actual asset being protected. For someone willing to compete seriously on pay and consistency, instead of racing to the bottom on wages, this can become a strong, resilient business with a real path to significant income. For someone planning to treat caregiver pay as the easiest place to cut costs, the $14,000 bill for that decision arrives quietly, one departure at a time. Last reminder, this video describes non-medical home care specifically, using national and multi-state figures. Actual licensing requirements, wage floors, and Medicaid rules vary meaningfully by state. It's not legal or business advice. If you're evaluating this for your specific state, that due diligence is yours to do. Remember this: nobody builds a lasting home care agency on the hourly rate. They build it on the caregiver who shows up reliably enough that a family never has to think about this business again. Protect that person, and the spread takes care of itself.